Hi everyone, welcome back. Now in this lecture, we are going to see how coupon rate and required rate of return actually influence the intrinsic value of a bond. Now let us take a situation where if the coupon rate is 8% and your required rate of return is 10%. All right, the coupon rate, let's say I am the company, you are the investor. What I am paying you is 8%, whereas you want your required rate of return is 10%. Then what is going to happen is the bond will actually trade at a discount. The bond will actually trade at a discount compared to its face value, and that discount, all right, let us say face value is $1,000, the bond will actually trade at say $950, and you are going to pay $950 for the bond today, and you will receive a gain of $50. 950 and $1,000, you will actually receive a gain of $50, and that $50 is translating into a 2% excess return for you. I'm repeating myself. I, as a company, am going to pay you only 8%, but you want a return of 10%. How are you going to earn that 10% return? You are going to pay only $950 today, but on maturity, you will receive $1,000. All right. So you have basically received capital gains of $50. You have basically received capital gains of $50. That $50 is translating into a 2% per annum return for you. All right. Although the coupon is 8%, you are basically receiving 10% in the form of coupon 8 plus a 2% per annum of capital gains. All right. The capital gains between the maturity value and the purchase price is what is giving you the additional 2% return per annum. Let us say if the coupon rate is 8% and the required rate of return is 7%. All right, the coupon rate is 8% and the required rate of return is actually 7%. Then it means that I am actually paying you 8%, but given my riskiness, you only require 7% as return. What will happen is you will pay, say, $1,030. You are basically going to pay $1,030 for the bond today, and you are going to receive only $1,000 at the end of maturity, which means you have paid $30 in excess. That capital loss is eroding that return. The capital loss is eroding 1% return for you on a per annum basis. Although I, as a company, am giving you 8%, that capital loss is eroding your 1% per annum return. All right, that $30 on a per annum basis is translating into a loss of 1% per annum. All right, so therefore, the premium that you're paying is basically eroding your coupon to effectively give you only 7%. All right, so what did we see? If the coupon rate is greater than the required rate of return, if the coupon rate is greater than the required rate of return, the bond will trade at a premium. All right, you're going to pay a higher value for the bond in such a way that the capital loss will erode your 1% return. If the coupon rate is less than the required rate of return, if the coupon rate is 8, your required rate of return is 10, then the bond will have to trade at a discount. The bond will trade at a discount so that you pay money only $950 today and you earn a capital gain of $50 in such a way that the $50 translates into a 2% per annum return for you. All right. So if coupon rate is greater than required rate of return, the bond trades at a premium. If the coupon rate is less than the required rate of return, then the bond trades at a discount. All right, obviously you don't have to buy hard them. If you logically think through also, you should be able to get the answer. What if the coupon rate is equal to the required rate of return? The bond will trade at its face value. If the coupon rate and the required rate of return are equal, the bond will trade at its face value. In the example that we took above, I took an example that the coupon rate is 6%, but my required rate of return is 7% per annum. The coupon rate is 6%. I, as a company, am only paying you 6%, whereas your required rate of return is 7% per annum. Take a pause for a minute and think through whether this bond should have been trading at a discount or this bond should have been trading at a premium. All right, take a minute, pause the video and think through. This bond should have actually been trading at a discount. Reason being, you need a return which is greater than what I am offering. All right, so basically you need a capital gain over and above what I am offering you as a coupon payment. All right, my whatever I'm offering you as a coupon payment is 6%. You need additional 1% capital gain. That capital gain will only come if the bond is actually trading at a discount. All right, if the bond is trading at a discount only, then that's going to translate into a capital gain, which will give you a 1% additional return. All right. So if the question was only this, and if it had asked you, is the bond trade going to trade at a discount, or is the bond going to trade at a premium compared to its face value, the answer would have been you need not actually calculate the intrinsic value. You should directly be able to actually answer that the bond would be trading at a discount. And we actually got an intrinsic value of 959, which is nothing but a discount, right? It's trading at a discount compared to its face value. If the coupon rate is greater than the required rate of return, then the bond will trade at a premium. And if it is equal, then the bond would be trading equal to its face value. All right. All right. Moving on to the next concept, which is yield to maturity, or YTM. Now, what is YTM? Assume that you're buying a bond today and you're holding the bond up to its maturity. All right. You're buying the bond today and you're holding the bond up to its maturity. Let us say maturity is 10 years. The return that you're going to get on this bond, or the IRR of this bond, is actually called as the yield to maturity. The word yield is nothing but return, right? The word yield is nothing but return. So yield to maturity means return up to its maturity. If you are holding the bond buying today, if you're holding the bond up to its maturity, what is the return that you're going to earn? What is the IRR? IRR is nothing but the return, right? Internal rate of return. What is the IRR of this bond? That is nothing but the yield to maturity. That is called as the yield to maturity. What you use to calculate as IRR in capital budgeting is called as YTM over here. If you think of it under capital budgeting, what you used to do, you actually had an outflow today. You used to have a outflow at Y0 with cash flows at Y1, Y2, Y3, Y4. That was capital budgeting. Calculate the IRR. That was for capital budgeting. Look at bond decision making. You have an outflow today in the form of market price. You have to buy the bond, you have to pay the money. So you have an outflow today in the form of market price, and then you have cash flows in the form of coupon. All right, cash flows in the form of coupon, and at the end you have maturity value. The IRR of all these cash flows is nothing but yield to maturity. The IRR under capital budgeting was nothing but the return. We are also we are calling it as return, but the terminology used is yield to maturity. Why have we added the words to maturity? Reason being, if you actually sell the bond sometime in between, then this need not necessarily be your return. This will be your return only if you actually hold the bond right up to its maturity. All right. So therefore, the YTM is the yield or return that an investor would earn if he holds the bond right up to its maturity. It's the YTM is the yield or return that an investor would earn if he holds the bond up to maturity. All right. Now, if you remember, even under capital budgeting, calculating IRR was something that you never used to do on calculators. All right. IRR can be never be easily calculated on calculator. What the institute used to do is it used to give you two discount rates as a hint, and you then used to do interpolation. If you recall, that's how you used to do IRR calculation for capital budgeting. Over here also, IRR cannot be exactly calculated using the normal calculators. All right. Therefore, we need a shortcut mechanism to actually calculate IRR. And after that shortcut mechanism, we will improve upon calculating the YTM. We'll improve. So first we'll calculate a shortcut YTM or an approximate YTM. Based on that, we will get a hint in which range the YTM is going to lie. And after that, we will do exact interpolation. All right. If you've not understood, you will understand through it the next example that I'm going to take. Let us say I have got a market price of a bond at $910. The coupon is $120. The face value $1,000 and maturity is 3 years. All right, face maturity is 3 years. Now, before we even calculate the YTM, if you think of it, market price of the bond is 910, which is it is trading at a discount. All right, coupon is 120, face value 1,000, coupon is 12 percentage. All right, market price is 910, coupon is $120, which is 12 percentage, and the maturity is 3 years. Think through it, give it a pause, think through. Is your return, all right, if you're buying something today at 910 and you're going to earn capital gains of $90 and you're also going to earn 12% coupon, is your return going to be greater than 12 percentage, or will it be less than 12 percentage? Is your return going to be greater than 12 percentage, or is your return going to be less than 12 percentage? Give it a moment and give it a thought. Your return obviously has to be greater than 12 percentage, right? Because you're earning capital gains of $90. That $90 capital gain should actually translate into a higher return for you. And therefore, even before you start calculating, you should know that the IRR that you're going to calculate will actually be greater than 12 percentage. The return that you're going to get from this bond is greater than 12 percentage. You should already know that before we proceed. All right. So if I plot down the cash flows, I have got year zero, which is right now. I will have to pay 900. Sorry, I think this was a typo. It is not 910, it is $970. All right. You have a cash flow of $970. Year 1 to 3, you're going to receive $120. Year 3, you're receiving $1,000. All right. 1 to 3, you're receiving 12% coupon. Year 3, you're receiving $1,000. You need to find the IRR of these cash flows, which is nothing but the YTM. All right. Now, firstly, the approximate method. This method is not going to give you the exact IRR. It is only an approximation. Now, what we are going to do under this method is we will first calculate what is the return that I'm getting. If you take a look at it, the return that I'm getting on a per annum basis is I get $120 of coupon. I have $30 of capital gain. Remember, it is not 910, it is 970. So therefore, I've got $30 of capital gain. 1000 minus 970, $30 of capital gain. But that $30 of capital gain is going to be earned over a period of 3 years. That $30 capital gain is for a period of 3 years. Therefore, I'm dividing it by 3. What is 3? The maturity is the 3 years. All right. How many years are left for maturity? That is the period, right? So $120 is the cash flow per annum, plus $30 is the capital gains on a per annum basis, that is $10. All right. So my total return is $130 on a per annum basis. 120 plus 10, $130 is my total return. Divided by, I do not do cost. I'm not doing cost, but I do an average of cost and face value. All right. The denominator, return, normal calculation of return is nothing but how much I'm getting divided by my cost price, right? That is how you calculate return as a percentage. But over here, instead of dividing it by the cost price, we're taking an average of cost price plus market plus maturity value or face value, the whole divided by 2. I will come to why we are taking an average a little later. It is unnecessary deviation of the topic, but on the denominator, we generally, what you already know is for calculating return, what we normally do is what am I receiving? Dividend divided by my cost. That is how you calculate return, right? Over here, we are in the denominator, instead of taking cost, we are basically taking cost plus maturity value. Or we are taking the current market value plus face value divided by 2. In the bottom, we are basically taking cost or current market value plus the face value, the whole divided by 2. So my denominator is 970 plus 1000, the whole divided by 2. So 1970 divided by 2. Whatever the numerator and denominator are, the approximate YTM that you are getting is 13.19 percentage, which is greater than the 12 percentage that we already discussed. All right, this is the approximate YTM. It's not the exact YTM. Your approximate return is actually 13.19 percentage. All right, if you buy the bond today at $910 with a coupon of $120 and a face value of $1,000, the return that you're basically earning in this bond is 13.19 percentage. I, as a company, I am only giving you $120. I'm only giving you $120. But because the bond is available at $970 in the market, that is effectively giving you a return of $30, which is translating into 1.19 percentage on a per annum basis. That $30 is translating into 1.19 percentage on a per annum basis, and that's effectively giving you a return of 13.19 percentage.
Approximate.
Now, this is to calculate the exact YTM. What we are going to do is we will actually now do an extrapolation. You know that the return has to now lie in the range of 13 and 14 or 13 and 13.5. All right. You could have either taken 13 and 14 or 13 and 13.5. Given that you know that this is the approximate YTM, I can now infer or I can now conclude that the return will probably lie between 13 and 13.5 percentage or 13 and 14 percentage. Anything is possible. I have taken over here 13 and 13.5 percentage. So what I'm basically going to do is I have now calculated the intrinsic value of a bond assuming 13 percentage as the discount rate and intrinsic value of a bond assuming 13.5 percentage as the discount rate. What have I done? I have calculated the intrinsic value of the bond, assuming 13% is the required return and assuming 13.5. If you remember the golden definition of IRR, it was that rate at which your discounted cash inflow and your discounted cash outflow were actually equal. All right. IRR is that rate at which your NPV is actually equal to zero. IRR is that rate at which your NPV is equal to zero, which means your discounted cash flow and your discounted cash outflow, inflow and outflow, they should actually be equal such that your NPV is actually equal to zero. Now, similarly, if I discount over here using IRR rate, all right, whatever the YTM or IRR rate, if I use it, the bond intrinsic value should exactly come as $970. These are my future cash inflows. If you're able to see them, these are my future cash inflows. The future cash inflow should exactly be equal to the cash outflow. Cash outflow is nothing but 970. All right. So I am saying that the IRR is that rate at which the bond future cash flows should exactly be equal to the market price of the bond. IRR is that rate at which the bond's future cash flows should exactly be equal to the market price being the outflow of the bond. All right. So I have therefore calculated the intrinsic value or the bond future cash flows. If I use 13% discount rate, I've got 976. If I use 13.5 discount rate, I've got 964.88. Now, if you carefully look at it, there is a gap of $11.5 between these two values. When the discount rate increased by 0.5 percentage, the gap between the discounted cash flows increased by $11.15. All right, I want this number to be 970, which means the gap I want is only 6.38. I'm looking at the gap from this number. All right, the gap I'm looking at it from this number. I want the gap only to be 6.38. If I increase the discount rate by zero point 0.5, the gap was $11.5. All right. So I want a gap of only 6.38 to bring it down to 970. Therefore, how much should I increase the discount rate? All right. So for 0.5% increase in discount rate, my gap was 11.5. I want a gap of only 6.38. Therefore, how much should I increase my discount rate by? A simple interpolation. So 6.38 divided by 11.5 multiplied by 0.5 percentage, I get 0.2744 percentage, which means I have to increase my discount rate by 0.2744. I have to increase my discount rate by 0.2744, which means if the discount rate is 13.2744, 13 plus 0.2744 is equal to 13.2744. Sorry, 2774. If the discount rate is 13.2774 percentage, then this discounted cash flows will exactly be equal to $970, which means my future cash inflows are exactly equal to the cash outflows, and that discount rate is nothing but my IRR, which is nothing but my YTM. All right. As a homework, what you have to do is use 13.2774 percentage as your discount rate and ensure that the bond's intrinsic value or the bond's cash flows, future cash flows, are actually equal to 970. You might still not exactly match it to 970, but it will be close enough. All right. Because over here also, this is also an approximation itself. All right. Over here, this is a refined YTM, but this is also still an approximate YTM, because ideally maybe you should have actually done the discounting between 13 and say 13.3 percentage. Then it would have been much more closer and much more accurate. But this is still fine, all right? Using a gap of 0.5 or 1 percentage is still fine. But essentially what I'm saying is 13.2774 percentage. If you use it, that will give you an effective future cash flows of 970, which is exactly equal to the current price of the bond. All right. So this is going to be your YTM of the bond, 13.2774. The approximate YTM was 13.19 percentage. A refined YTM is 13.27. 13.19 versus 13.27 percentage. All right. So this is how you actually calculate the approximate YTM and the refined YTM as well. All right. Okay. So now I defined YTM as what is the return that an investor will earn. All right. If you remember, I defined YTM as what is the return that an investor will earn. So if you buy this bond today at $970, and if the coupon is $120 and the face value is 1,000, and if the maturity is 3 years, you are earning a return of 13.2774 percentage. Your return that you're earning is 13.2774 percentage. Now I would like to introduce a major caveat or a major rider or a major condition. All right, caveat refers to a condition. Your return would only be 13.2774 if the intermittent cash flows of $60, what you're receiving in the form of coupon, if those cash flows are also again reinvested, and they are also again reinvested at 13.2774. I'm repeating myself. If let us say you have invested in this bond and you have bought this bond at $970. All right. You have purchased this bond at 970. You have received a cash flow or a coupon of $120 after year one. If you go and take those $120 and keep it in your pocket, it's going to earn 0% return. It's going to earn 0% return. In that case, your actual real return will not be 13.27. For your real actual return to be 13.27 percentage, this $120 that you received should also be reinvested again at 13.27. Similarly, at the end of year two, you're again going to be receiving $120. That end of year two $120 should again be reinvested at 13.27 percentage. Only if your reinvestment rate is equal to 13.27, then your actual real return or the realized YTM, what I call as the realized YTM, or the realized YTM will be equal to your actual YTM that we calculated if you reinvest the coupon also at the YTM rate. All right. So your realized rate of return will actually be equal to your YTM only if you reinvest the coupon also at the YTM rate. All right. If instead of reinvesting, if you take the coupon and keep it in your pocket, which is earning 0% rate of return, then your realized return will actually not be equal to 13.27 percentage. Your realized return will actually be less than 13.27. All right. If you are actually able to reinvest this coupon at a rate greater than 13.27, if the coupon that you received of $120, if you're able to invest it at say 15 percentage, then your realized return will be even greater than YTM. All right. Your realized return will be even greater than YTM. First, I said YTM is the return that you're earning. Now I'm refining that and I'm additionally saying that for you to actually earn YTM or for you to actually earn 13.27 percentage, you also have to reinvest the intermittent cash flows. Year one cash flow of $120, you have to invest it at 13.27 percentage for 2 years. All right, because there are still 2 years left to maturity, right? There are still 2 years left for bond maturity. So the $120 that you have received at the end of year one, you should reinvest it at 13.27% for 2 years. The year two $120 that you have received, you should reinvest it again for one more year at 13.27 percentage. And this will definitely give you a realized return of 13.27. If you reinvest it at a rate greater than or less than the YTM percentage, then your realized return will also fluctuate accordingly. If your reinvestment rate is less than 13.27, then your realized return will be less than YTM. If your reinvestment rate is 15 percentage greater than the YTM, then your realized return will be greater than the YTM. All right. Now, here comes a risk. All right. That risk is what we refer to as reinvestment risk. What is the risk that we're talking about? What is the guarantee that after 1 year I will actually be able to find an instrument in the market which is actually giving me 13.27 percentage? There is no guarantee that after 1 year I will be able to find a bond, or I will be able to find an instrument which is giving me 13.27 percentage, right? So this is the risk. All right, and this risk is called as reinvestment risk. This risk is called as reinvestment risk, wherein we are saying that there is uncertainty at what rate I will actually be able to reinvest my coupon. I do not know at what rate I will be able to reinvest my coupon after 1 year or after 2 years. And that rate and then that risk is what we refer to as reinvestment risk. Therefore, there is a big risk as to whether you will actually earn your actual return will be equal to YTM or not. There is a big risk whether your actual return will be equal to YTM or not, and that risk is what we are referring to as reinvestment risk. All right, I'm repeating myself. Whether your actual return will be equal to YTM or not is dependent on whether you're able to reinvest the coupon that you're receiving at the YTM rate itself. All right, and because there is uncertainty in it, although you have bought a bond today, when you're buying a bond today, you are actually very happy that you got a bond with a YTM of 13.27. But you shouldn't dance today, because in this 13.27 percentage of YTM, there is a risk as to whether you will be able to reinvest your coupon of $120 again at the same rate or not. If you're not able to reinvest the coupon at 13.27 percentage, your realized return will actually be less than the YTM that we have calculated. All right, that's it for this lecture, guys. See you in the next lecture, where we'll discuss about duration and volatility.